What is going on, guys? Welcome back to the Traveling Trader. In this video, I just wanted to give you a little bit of a quick market update. Hopefully instill some calm in those that are panicking, especially for some of the newer traders out there. I know that a lot of you were born after the March 2020 crash, which this is obviously nothing in comparison to what folks back then in February 2020 experienced. So hopefully I can provide you with some calm, focused analysis on the markets, where I think the markets are going. NASDAQ just hit correction territory, as I suspected it would. I still don't think we're hitting bear market territory, meaning a drop of 20% or more. Everything hinges really on the jobs report, stimulus, and then the reopening of the economy. But I'll tell you how I'm approaching this from a trading perspective. So let's get right into it. All right, so looking at NASDAQ, like I said, we are already in correction territory. We did hit that 10%. And a correction is a drop of 10%, but not more than 20%. So between 10 and 20%, we hit that correction territory on the NASDAQ. The NASDAQ obviously being the most tech heavy. Now, here's what's important. And actually something that is maybe a silver lining is that also happens to be the previous resistance when we broke out from all-time highs. Now, I wanted to instill some calm in this way. So this right here is the COVID lows, right? This is from the pandemic crash in March 2020. And I want you to look at the NASDAQ. Obviously, it is a beast of an index. It only goes up. It really only goes up. I know there's that funny meme, stonks only go up, but the NASDAQ really only goes up if you zoom out and look at it from a long-term view. The other thing is that previous lows, right? Like this pandemic crash seemed like the end of the world for those of us that were in the markets back in February. However, these previous lows were once, not even that long ago, the index highs, right? So if you go to 2018, this was a NASDAQ all-time high. And the pandemic low from March 2020, that low, it basically dropped to the previous highs. So the point that I'm trying to make is it seems like the current time is the worst time, right? Like the current crash is the worst crash because it's the one that has the most effect on you and on your bank account. However, these lows at one point were the previous highs. So in this case, is the NASDAQ going to bounce from here? I would venture to say that it really depends on the stimulus this weekend and the jobs report. If the stimulus if the stimulus is undecided upon, if the jobs report is negative, I do think that we can come down and retest this 200-day moving average on the NASDAQ. If we take a look at the S&P 500, it's a very similar story, but the S&P has not hit correction territory yet. However, it does have almost a very similar trajectory. It's just that we haven't gone as low on the S&P 500. Now, I do believe that the S&P 500 does have more room to drop, and it would put us in correction territory in between the 100-day moving average and the 200-day moving average, which again would be near the previous highs. So it's important to keep perspective here. I personally don't think that we're going to enter a bear market where you see a 20% drop. A 20% drop would take us to levels that we haven't seen since the actual height of the pandemic. But also, obviously, I could be wrong. I'm not Nostradamus, and I will obviously tell you if I'm wrong. But that's just my analysis at the moment. I don't think we're going to another bear market. Also, if you look at this chart of the history of bear and bull markets, this is going all the way back to 1942. It's put together by First Trust. You'll see that the average period that a bull market lasts is 4.4 years. Now, the average period that a bear market lasts is 11.3 months. So 4 to 5 times less. Bull markets usually run 4 to 5 times longer than bear markets. So anyone feeling any pain right now, just know that on average, bear markets last a lot less than bull markets. And we're not even in a bear market. Now, the other reason I bring this up is because bull markets tend to last for multiple years. Like I said, the average is 4.4 years, right? So while it is certainly possible that we get back-to-back bear markets, it is not plausible and definitely not backed by history. But a lot of analysts don't even view that. They view the entire thing as one long bear market. However, here on this chart, they do separate it out and say that, we did have 3 months of a bull market and then another bear market. But most analysts refer to this period as one long bear market. So Depends on who you talk to. Now, one other thing I will highlight for you is the price oscillator here on, this is the QQQ, which is the NASDAQ ETF, is running really hot right now. And when we get to these types of levels and we start getting that V shape, we do tend to see a bounce from here. So again, if the jobs report is good and if we do actually pass stimulus on the weekend, I will venture to say that the NASDAQ will bounce off of the 100-day moving average. Again, I could be wrong, and I'm fine with that. Now, before we get into the trades, another thing to keep in mind, obviously corrections are necessary. Things can't go up in a straight line forever. They are necessary for the market to reset, get back to reality so that investors can reset their confidence back in the market for it to go on another run. As I said, on that chart, right, the current lows used to be the previous highs in a different time period. So that needs to happen in order. It's just human nature that things regress to the mean. It needs to happen in order for reality to set in. We had so many stocks that were running insanely high. I mean, you look at stocks like Booking, you look at stocks like Disney, you look at stocks like Las Vegas Sands. I mean, the economy isn't even halfway reopened, and these stocks are higher now than they were before the pandemic. So obviously people were running out of places to put money. There's low interest rates. There really isn't anywhere to put money. So people were putting their money in equities. A lot of the stimulus money made its way to equity. So these stocks were running hotter than they probably should have been for the current time period. But the good news is that they get to reset for when the reopening does take place, and we will see a continuation of the bull rally. Now, I also sent this out in the trade alerts, but there is also somewhat of a rotation going on. So not all stocks are tanking. A lot of the tech-heavy stocks are tanking. But I do think that if you haven't started rotating into some of these other recovery stocks, that now is a good opportunity to rebalance your portfolio. So Disney, for instance, I'm buying Disney on any weakness. Obviously, Disney Plus has been doing astounding numbers. Disneyland isn't even reopened yet. So on any weakness, I am adding to my Disney position for the long term. You look at a stock like Airbnb, which is also a reopening place, sitting at the 50-day moving average near its support after the IPO run-up. You look at Jets, which we actually bought in January. Jets still has a long way to go to get back to where it was pre-pandemic. It's trading at $25 right now. It was $31 pre-pandemic. You look at Carnival Cruise. This one has like a 60 to 80% upside to get back to where it was pre-pandemic. And then obviously I'm not saying don't invest in tech. There are a lot of good opportunities right now. Look at Salesforce sitting at the 300. I don't have it pulled up, but it's near the 300-day moving average. Look at AMD, which is, I believe, at the 200-day moving average. You look at Apple. This is near the 100-day moving average. Could be a little bit below. Yes, almost at the 200-day moving average. Look at Tesla, a stock that everyone complains about that says, oh man, Tesla never drops. Well, now it's at the 100-day moving average. You're comfortable buying it at 900, but not at 600. That doesn't make sense. Even if you look at something like NIO, which is a great opportunity if you can get it for cheap. NIO is heading towards the 200-day moving average. It could be $30 really soon, although it is looking a bit overextended here. But the point is, don't try to find the bottom. You see cheap opportunities on stocks that you've wanted to hold, you can nibble on them and start dollar cost averaging into them. Taiwan Semiconductors is one that I'm super bullish on. This one is now near the 100-day moving average. Palantir, an absolute monster. We sold puts on Palantir. Now it is at near the 100-day moving average, made a bit of a recovery today, but absolute beast. So this market drawdown is one that a lot of new traders were waiting for because, you always hear the complaint, oh, I wasn't involved in the stock market back in March. I didn't buy any of this stuff for cheap. Well, now a lot of things are a lot cheaper than they used to be. Take this opportunity to rebalance your portfolio. Do an audit. Look at, are you too heavy into penny stocks? Are you too heavy into really risky stocks, right? Like if the market is down 10%, but your portfolio is down 50%, then there's something skewed there. There's something that's off balance that shouldn't be. Take this opportunity to build a solid long-term portfolio. This is a long game. Yes, you can play risky stuff. Yes, you can get into penny stocks and options, but those should be the dessert to your main course. Your main course being a solid long-term portfolio based on blue chip stocks that you bought on the dip and the crash. Learn to set stop limits. A lot of you have been asking, oh, well, what if I don't have any more cash? I'm holding all of these penny stocks and they're down 60-70%, and I don't have any more cash to buy, these blue chip companies. Well, that's when you learn to set stop limits. So as I was saying in our trading group since the end of December, I was saying time and time again, set stop limits on your risky holdings, because if the market starts drawing down, right? The market was feeling a little toppy. If the market starts drawing down, you want to exit those positions. That cash that you have now exited those positions with, that cash is what you would use to enter quality stocks on the dips and crashes, assuming that you're not bringing in more cash from outside sources. Anyway, traders, just to sum it up, my thoughts, I don't think we're going to a bear market. I do think that we do have a chance of bouncing if we get a positive jobs report and if we get a stimulus passed this weekend or closer to being passed this weekend. Take this opportunity to focus on rebalancing your portfolio, do an audit. Make sure that your portfolio isn't skewed too heavily into NEO or too heavily into some penny stock. You want to have quality stocks that you buy on the dips and crashes, and then sprinkle it with some of these riskier plays that you're interested in. Learn how to set stop limits for the future. Learn how to read a chart even. Get a rudimentary understanding of how to read a chart. TradingView is free. Get a free TradingView account. And last but not least, don't fret. Again, every new low was once the high in the stock market, right? Do not fret. The stock market has a 100% success rate. This is what the NASDAQ looks like over a period of more than 10 years. It's just one straight line up. So try to not focus on the day-to-day. Hopefully that helps you. Give it a big fat thumbs up if you got anything out of this video. If you have a question for me, leave it in the comment section below. I will be trying to go live in the Discord maybe on Friday as well as this weekend to answer some of your questions. Hopefully try to alleviate some of your fears. If you want access to our private trading group, link is in the description below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.